Are we on the verge of a massive market meltdown? Join us as top economists and financial analysts reveal shocking predictions of up to a 70% stock market plunge and an impending economic accident. We'll also explore the explosive potential for Bitcoin, with insights showing what's fueling its next parabolic move. Don't miss out on these critical warnings and opportunities. Like and subscribe for essential updates. Today, on Financial News in Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money, we have John Hussman. The speculative market advance since 2009 ended last week. Stocks may fall up to 70 cents. From Blockworks Macro, we have risk of an economic accident are rising, says Economist, who predicted no recession in 2023. From Kitco News, we have as banks pass stress tests, do Biden and Trump's crypto policies signal change? Kitco News. From Kitco News, we have top 3 Bitcoin price drivers that could trigger next explosive parabolic move, Anthony Pompliano. From the Julia Roche show, we have prepare for a correction, Ed Dowd. In this recent insightful video on Thoughtful Money, host Adam Taggart engages with renowned economist, market analyst, and founder of Hussman Strategic Advisors, Dr. John Hussman. The discussion centers around Hussman's new proclamation that the speculative market advance since 2009 has ended, suggesting a significant market downturn ahead. Dr. John Hussman's core thesis posits that the speculative market surge we've seen since 2009 likely ended last week. Using historical data and advanced valuation measures, Hussman warns that extreme valuations combined with poor market internals indicate potential downside risks for the S&P 500, possibly leading to declines of 50 to 70%. This assertion is backed by extensive analysis akin to prior accurate predictions he made before significant market crashes like the dot-com bust and the Great Financial Crisis, GFC. Here are the key points discussed by Dr. John Hussman. Unfavorable market conditions. Current market conditions reflect extreme valuations and deteriorating market internals. Hussman emphasizes the presence of a rare combination of warning syndromes in both weekly and daily data. His commentary parallels the market conditions seen before the dot-com bust and the GFC. Valuation metrics. The ratio of non-financial market capitalization to non-financial gross value added is at historically high levels. Even traditional valuation measures, like price to forward earnings, show the market is exceedingly overvalued. Current valuations exceed peaks seen in both 1929 and 2000, signaling limited future returns. Breadth and market internals. Indicators of investor sentiment and market breadth are showing critical signs of stress. There has been a significant uptick in companies hitting new 52-week lows, even as the larger indices hit new highs. Hussman elaborates on how this dispersion was a precursor to previous market declines. Historical comparisons and data. Historical data models developed by Hussman show a strong correlation between current market conditions and previous substantial market corrections. Charts show valuation versus subsequent risk premiums, painting a concerning picture of low expected returns. Dr. John Hussman made the following predictions. Potential market decline. Hussman forecasts a potential S&P 500 decline in the range of 50 to 70% to restore long-term expected returns to 10%. He insists that such a decline, though seemingly preposterous, is well within historical precedents and current valuation extremes. Recession and downturn risks. Hussman suggests we are on the cusp of a recession, with many employment data points and financial indicators starting to align with recessionary trends. The prolonged effect of ultra-low interest rates and debt refinancing suggests potential margin pressure and economic strain ahead. Dr. John Hussman concludes by urging investors to reassess their risk exposure in the context of potential historical market declines. He stresses that while market tops are difficult to pinpoint, the need for caution and preparedness has never been more crucial, given the current extreme valuations and waning market internals. He advises that investors should prepare for potentially severe downturns by evaluating their risk tolerance and opting for financial strategies that mitigate regret, particularly focusing on diversification and safer assets during these uncertain times. Welcome back to Blockworks Macro. In this episode of Forward Guidance, host Jack Farley sits down with Neil Dutta, head of economic research at Renaissance Macro. Neil's a recognized expert with a solid track record, having correctly called for no recession in 2023. Today, he's here to talk about the evolving risks in the U.S. economy and the potential for what he calls an economic accident. Keep in mind, Neil's views stem from his professional expertise at Renaissance Macro, and he may possess a natural bias towards emphasizing economic caution to align with his advisory role. The core thesis revolves around the shifting economic landscape and the growing risks of an economic accident in the U.S. Neil argues that while the economy has so far avoided a recession, signs are increasingly pointing towards potential troubles ahead. These risks are underscored by an evolving labor market and the Federal Reserve's hawkish policy stance, which could eventually force the Fed to make significant adjustments if the economic data continues to shift. Here are the key points discussed by Neil Dutta. Fed's hawkish stance. The Fed's recent decisions include revising their inflation numbers up and reducing the anticipated rate cuts for this year. Neil highlights the sustained hawkish rhetoric coming from various regional Fed presidents, suggesting the Fed is leaning towards tighter monetary conditions if inflation doesn't drop swiftly. Labor market dynamics. The labor market shows signs of weakening, even though job gains in non-farm payrolls remain robust. Neil mentions that the unemployment rate has ticked up to 4% from 3.5% over the past year, implying a cooling trend in the labor market. Inflationary and deflationary pressures. Neil asserts that the inflationary pressures from the job market have lessened, with average hourly earnings stabilizing. He adds that recent inflation data shows signs of downward momentum, which could compel the Fed to cut rates to avoid adding unnecessary strain on the economy. Neil Dutta made the following predictions: rate cuts by end of year. Neil predicts that the Fed will likely have to initiate rate cuts, potentially as soon as September, if inflation data continues to show significant slowing. He foresees the Fed making around 3 rate cuts by the end of the year to recalibrate monetary policy and stabilize the economy. Disinflation and economic adjustment. With core inflation expected to fall to around 2% by Q1 of next year, Neil suggests that the Fed will need to maintain an easing bias to accommodate this deceleration. He warns that if the Fed delays these adjustments, it could exacerbate economic fragility, leading to higher unemployment and potentially more severe market corrections. Neil Dutta wraps up his insights by emphasizing the importance of the Federal Reserve taking appropriate and timely actions to manage monetary policy effectively. His final call to action for viewers involves staying informed about market dynamics and preparing for possible rate adjustments. He also suggests a cautious but active monitoring of labor market trends and inflation data to ensure sound investment decisions. Hey everyone, welcome back to Kitco News. In today's episode, we explore some critical developments from the financial world, housing market, political arena, and international news. Hosted by Jeremy Saffer, this episode delivers a comprehensive analysis of the recent U.S. bank stress tests, noteworthy political maneuvers by Biden and Trump regarding cryptocurrencies, and other headline stories. In this video, the core discussion centers on the resilience of major U.S. banks amid economic uncertainties, the diverging cryptocurrency policies of Biden and Trump, and the broader implications these could have on the financial landscape and global markets. The episode covers insights into each topic with data, expert opinions, and potential future scenarios. Here are the key points discussed by Jeremy Saffer. U.S. bank stress tests. All 31 major U.S. banks passed the Federal Reserve's stress tests, demonstrating strong capital reserves despite challenging economic scenarios. The stress test simulated a severe global recession, a 40% drop in commercial real estate prices, and unemployment peaking at 10%. Vice Chair for Supervision Michael Spar emphasized the bank's resilience in supporting the economy even during significant downturns. Housing market challenges. New single-family home sales dropped by 11.3%, reaching an annual pace of 69,000 units, the lowest since last November. The decline is attributed to elevated mortgage rates, hovering around 7 to 8%, and persistently high home prices. Builders are offering incentives like price cuts and closing cost assistance to attract buyers amidst decreasing affordability. Biden versus Trump's cryptocurrency policies. Former President Trump plans to attend the Bitcoin 2024 convention, indicating strong support for cryptocurrencies and aiming to resonate with young voters and tech enthusiasts. President Biden's campaign focuses on regulatory frameworks for cryptocurrencies, consumer protection, and market stability, highlighted by his 2022 executive order advocating for detailed research into digital currencies. These diverging policies suggest significantly different futures for America's approach to cryptocurrency. Supreme Court decision on social media. The Supreme Court affirmed the Biden administration's right to work with social media companies to address misinformation. The decision could lead to increased government control over online speech, particularly concerning as elections approach. Julian Assange's return to Australia. Julian Assange has returned to Australia following a plea agreement with the U.S. Department of Justice, ending his legal struggle in the U.S. This development rekindles debates on the balance between national security and freedom of the press. Victoria Gold's Eagle Mine incident. A critical failure at the Eagle Gold Mine in the Yukon Territory has caused significant infrastructure damage, though no injuries were reported. The mine has temporarily suspended operations, and recovery plans are being formulated in collaboration with local authorities. Jeremy Saffer made the following predictions. Potential changes in cryptocurrency regulations. If Trump is elected, there may be a surge in legislative support for cryptocurrencies, potentially lessening regulatory pressures. Under Biden, stricter regulatory frameworks and increased focus on market stability and consumer protection may continue. Housing market struggles. Persistently high home prices and elevated mortgage rates could lead to further declines in home sales and increased financial strain for potential homebuyers. In summary, the video highlights the resilience of major U.S. banks amid economic uncertainties, different political approaches to cryptocurrency by Biden and Trump, and various challenges in the housing market and broader international landscape. Viewers are encouraged to stay informed on financial regulations, housing market trends, and political developments, as these factors will significantly shape the future economic environment. Welcome to Kitco News. In today's episode, host Michelle McCory sits down with Anthony Pompliano, a well-known entrepreneur and tech investor. We're diving deep into the current and future drivers of Bitcoin's price, tackling everything from corporate involvement to political factors. Pompliano, also known as Pomp, runs a family office, pens the popular Pomp letter, and hosts the Pomp podcast. With such credentials, Pomp brings an insightful yet unbiased perspective on Bitcoin and its market dynamics. The core thesis of the video centers around three main drivers that could trigger the next explosive parabolic move in Bitcoin's price. Pompliano identifies significant corporate balance sheet allocations to Bitcoin, influential political outcomes, and regulatory clarity as the key factors that will propel Bitcoin to new heights. He argues that these elements will not only drive substantial market demand, but also reinforce Bitcoin's standing in the financial ecosystem. Here are the key points discussed by Anthony Pompliano. Corporate balance sheets. Public companies might start adding Bitcoin as a treasury asset. This trend was initiated by Michael Saylor's MicroStrategy and could snowball into larger, more mainstream corporations like Dell. If a small percentage of corporate balance sheets move to Bitcoin, it could inject immense buying power and drive prices upward. Political influence. Former President Trump has dramatically shifted his stance to become pro-Bitcoin, suggesting this political backing could catalyze greater adoption. The Biden administration has been tacitly supportive, with its regulators approving Bitcoin ETFs, fostering a more favorable environment for Bitcoin. Regulatory environment. The government's stance on Bitcoin has significantly evolved, with both political parties now showing varying degrees of support. Pompliano dismisses the notion that Bitcoin could be regulated out of existence, suggesting it's instead becoming a necessity for the government. Anthony Pompliano made the following predictions. Corporate adoption. Pompliano predicts that more public companies will add Bitcoin to their balance sheets, driven less by a desire to emulate MicroStrategy and more by practical economic benefits. Political shifts. Pompliano forecasts that pro-Bitcoin political candidates, especially if Trump gains more traction, could signal a golden era for Bitcoin, igniting further price hikes. Stability amid regulatory changes. Pompliano asserts that the acceptance and regulation by mainstream financial institutions will stabilize Bitcoin, cementing its role in global markets. Pompliano concludes with a strong endorsement for Bitcoin's future, emphasizing the alignment of corporate interests, political shifts, and regulatory clarity. He urges viewers to focus on the long-term potential rather than short-term market fluctuations, highlighting how these factors collectively set the stage for Bitcoin's significant growth. He leaves the audience with a hopeful outlook, suggesting that Bitcoin's adoption curve is only beginning. Today on the Julia LaRoche Show, we delve into a riveting conversation with Ed Dowd, founding partner at Finance Technologies, an alternative global macro investment firm. We will explore the looming economic correction, the state of the global and U.S. economies, and the impact of recent monetary policies. The essence of the discussion with Ed Dowd is his assertion that we are on the brink of a significant economic correction due to the accumulated global debt since the Great Financial Crisis. Dowd believes that the Federal Reserve's rapid rate hikes have peaked and the delayed effects are about to trigger a slowdown in both the U.S. and global economies, exacerbated by issues such as wealth inequality and inflation. He advises caution and preparation for a downturn that the markets and policymakers might not be fully prepared to handle. Here are the key points discussed by Ed Dowd: global debt problem. Dowd underscores that global debt has ballooned since the Great Financial Crisis. He attributes the current economic risk to unprecedented spending during the COVID-19 pandemic, which acted like a war in terms of fiscal impact. Monetary policy and rate hikes. The Federal Reserve has raised interest rates by 550 basis points in an effort to combat inflation. Dowd believes these rate hikes have peaked and their lagging effects are now hitting the economy. Economic inequality and inflation. Wealth inequality has widened since the pandemic, squeezing the middle class. Indicators such as rising credit card and auto loan delinquencies signal a struggling real economy. Stock market fragility. The stock market is considered unhealthy, propped up by a handful of stocks, similar to the 2007 scenario. Divergences in market indices and technical indicators suggest potential market instability. Potential policy responses. Dowd anticipates that the Federal Reserve may cut interest rates soon, potentially by 50 to 100 basis points, which historically signals a bad omen for the economy. Ed Dowd made the following predictions: economic slowdown and market correction. Dowd expects economic slowdown to manifest in a significant market correction, as the real effects of monetary tightening impact the economy. He foresees a potential 50% drop in the stock market during a recession. Rise of deflationary pressures. After an initial deflationary recession, there will be volatile bouts of inflation and deflation influenced by central bank interventions. Global currency crisis. A potential currency crisis could be triggered by issues in countries like Japan, which has a 250% debt to GDP ratio. Dowd suggests a possible dramatic rise in the USD-JPY currency pair, leading to global financial stress. Ed Dowd concludes that current economic conditions require cautious preparation. He advocates for diversifying investments into assets like T-bills and government money market funds to maintain dry powder for impending corrections. While he predicts a challenging period ahead, he also sees potential opportunities for younger generations to invest during market lows. Dowd emphasizes the need for policy reforms and cautions against the implementation of CBDCs and UBI, which he believes would further erode economic freedoms. In today's expert discussions, our guests provided a variety of critical insights into potential market turbulence. Dr. John Hussman warns that the stock market could plummet by 50 to 70%, likening current market conditions to pre-dot-com and GFC scenarios. Neil Dutta argues that an economic accident is increasingly likely due to the Federal Reserve's hawkish stance and evolving labor market dynamics, predicting necessary rate cuts by end of year. Meanwhile, Anthony Pompliano is bullish on Bitcoin, forecasting significant price increases driven by corporate adoption and political support. Ed Dowd sounded the alarm on a looming economic correction due to global debt and speculative stock market stability. While our experts share concerns about economic instability and market stress, they diverge on their views about the resilience and future direction of Bitcoin. Stay tuned for more in-depth analyses, and remember to diversify and reassess your investments to mitigate potential risk. Thanks for watching Financial News and Review for June 27, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.